For this panel, we're going to discuss the intersection of education and crowdfunding. Because let's face it, most students today, they don't want to report to a boss, they want to be their own boss. So that said, it's really important to educate our youth. We want to teach them how to responsibly raise funds. So for this discussion, I'd like to introduce my panel, Nicolas Leeper. He's the vice president at SeedInvest. We also have Ethan Mollick. He teaches a course on crowdfunding at Wharton. And we have Krishan Arora, founder and CEO of the Arora Project. So his agency actually was able to raise over $30 million for startup founders. And I want to talk to you about that. Let's start off talking about the difference between two broad cases of crowdfunding. We have rewards, we also have equity-based, and that's two very different options for entrepreneurs, for investors. So tell me, what are the biggest differences with
Great
those
question.
two?
You know, throughout the event, I've been hearing crowdfunding, and I've been meaning to come and sort of have this conversation with the audience. When the term crowdfunding is used, it is, in sort of the more traditional sense, focused on rewards-based crowdfunding, which is Kickstarter and Indiegogo. That market has been in existence for a little over a decade and is a multi-billion-dollar sort of market. Kickstarter has raised over $3 billion in a good part of a decade. Indiegogo is a little over $1 billion. And when people say rewards-based crowdfunding, what that really means is a pre-order model. Let's say Ethan and I get together and we create a solar panel cell phone case for the iPhone. And we say, great, we have one fully functioning, working prototype. How do we get access to capital? I mean, there's VC and angel funding, which is kind of hard to get at the early stage. There's bank loans, which is even a little harder to get unless you have collateral. Crowdfunding took off where you can go to Kickstarter and Indiegogo, put up a campaign and say, we have created the most effective, the first ever solar panel cell phone case, pre-order the case from me, and in 3 to 6 to 9 months, I will then deliver it to you after. And hopefully you have it discounted off MSRP, but still have a little margin left in there for you after you deliver the products. That's rewards-based crowdfunding, which is a multi-billion-dollar industry that's been in existence for over a decade. This specific conference has been a lot more focused on equity crowdfunding, which is the exchange of securities through an online crowdfunding campaign, which is vastly different. You're not getting a product in return, you're getting equity in a company in return.
And speaking of equity, Nico, equity is a newer phenomena, and it is very similar to raising money through venture capital. So why would a company even turn to the crowd?
Yeah, that's a great question. I'd say a lot of the companies that we work with at SeedInvest are incorporating the crowd as part of their overall fundraise. The companies that we invest in are companies that traditional angel investors, that VCs invest in, and equity crowdfunding is one part of that solution. A lot of companies that are consumer-facing will incorporate equity crowdfunding into the mix because it turns your fundraise into this dual fundraising activity, but also a marketing activity. We look at a good corollary being public market investors, where if I'm invested in Apple, I think the stats are you spend something like 62% more dollars with that company, and you're twice as likely to recommend that company to your friends, your family, or your network. Granted, that's a public company. I don't have necessarily a personal relationship with a giant corporation versus when you're investing in startups where you're investing in a team, you're investing in a vision. So we've anecdotally seen at SeedInvest our investors be even more engaged with the companies they're investing in. So that's a really big driver. Another driver that we see, and this is probably a little bit more common at the later stage, kind of large Series A, Series B raises, is we see a lot of second-time founders where maybe they've previously taken capital from some of the biggest names in Silicon Valley, from top-tier VC funds. And what they saw when they took on that VC money is it oftentimes comes with a lot of strings attached, where maybe at their last company, a VC came in and essentially took a couple board seats, essentially ran the show. So for those more experienced founders that maybe want to retain a little bit more control of their company, this model can be very attractive where rather than having one large institutional come in and dictate how your company is run, you can kind of retain control of your company and spread that ownership through hundreds or even potentially thousands of smaller investors.
And Ethan, what do you think? Do you think the crowd fosters better outcomes?
So I can tell you that from the stats that we have that crowdfunding turns into real companies at a remarkably high rate. So on average, for every dollar you raise on Kickstarter, you make $2.40 in additional revenue outside. Substantial numbers turn into real companies. About 10% get additional funding through outside sources. So it seems to be a real path to entrepreneurship, mostly for smaller companies, but also some of the bigger ventures that my other panelists work with.
And this panel really is about educating entrepreneurs, educating investors. So what are the key things an entrepreneur needs to be aware of if they're looking to get investment from the crowd?
So it turns out that it's not trivial is the problem. It seems easy. It isn't. So there is a direct correlation between the number of hours you spend in advance, and the average is somewhere between 30 and 40 hours a week preparing for your campaign for many weeks in advance, and the outcomes that you get. The preparing, and I'm sure the other panelists can talk about it, about preparing the way by having a big mailing list in advance. So it's not trivial. And then the other big advice that I would give is to make sure you set your goal for exactly what you want to achieve, because viral hits are rare. Most people get exactly what they want, right? So trying to make sure that you're really prepared, done the research, looked at other campaigns in advance, all of that's critical.
And Krishan?
Right. To piggyback on Ethan's point, one of the most fundamental concepts of success in the crowdfunding space, both in the rewards-based crowdfunding and in the equity crowdfunding space, as Ethan said, is preparation. You know, at my agency, we have a very robust 8-week preparation program that we've really condensed a 4-month preparation plan down to 8 weeks, because we've had sort of scope and scale to refine that down further and further. Building an email list, activating a friends and family round around you, reaching out to organizations that are around you that can support you. That is of quintessential importance before you launch a crowdfunding campaign. And so many crowdfunding campaigners, both on the equity and the reward side, reach out to us. Hey, we're live. How do we get the money? I'm like, you know, you've missed the boat by over 2.5 months, right? Like that question was supposed to be asked 90 days ago. So preparation is key. And as Ethan, who's analyzed massive amounts of data in the crowdfunding space, there's a direct correlation in success preparation-wise and then during campaign.
And what I'll say specifically to equity crowdfunding, what we see crowdfunder investors look for in a company, it's oftentimes the same things that traditional VC and angel investors are looking for. So if you're, an idea on a napkin, if you're pre-MVP, we have a lot of companies that come to us at that stage, and we turn them away because we know that deal is not going to resonate with our investors. At the very earliest, we see equity crowdfunding working for teams that have at least 2 full-time founders, an MVP in place, and if you're going to be that early, there needs to be some kind of form of extraordinary traction, whether that be potentially a very large strategic partnership that you have in place, a really robust community that you've built around it at that early stage. There needs to be something special there if a company that early is going to have a successful fundraise with an equity crowdfunding raise.
Can I agree with one thing
Sure,
and disagree with one thing? So just important 2 notes, right? One is completely right. We've done a lot of work across many fields, from looking at National Endowment of the Art judges judging theater projects that raise money in Kickstarter, to looking at what VCs back later on. And you're right, experts and the crowd tend to agree with each other a lot. If they're different, it's mostly because the crowd is more willing to accept higher risk than the experts are, and they're actually more right than the experts are at high risk return ventures. Where I'd push back, the only thing I'd say is we've actually looked at the number of people on the campaign you need to be successful. It turns out solo run campaigns are more likely to turn into long-term successes than teams of 2. So even though everyone tells you teams of 2 are important, it turns out that the politics of having 2 people arguing with each other dissolves teams at a higher rate than the success comes from that.
So this is interesting insight for entrepreneurs, but Nico, I also want to ask you about the investor side. In the crowdfunding area, investors are unlikely, and in any investment really, they're unlikely to see any sort of return right away. So when you're dealing with non-accredited investors, what advice would you give them as far as getting involved in the startup asset class?
Yeah, so for the vast majority of investors that we work with, even both accredited and non-accredited, this is the first time that they're having access to direct startup investments. So there is a massive educational hurdle that we need to take upon ourselves as an intermediary to make sure that our investors are operating in this asset class in a responsible manner. Because if you do it responsibly, if you incorporate VC investments into your overall investment portfolio, they can deliver decent returns. But it's also really easy to mess it up. So we talk to our investors a lot about proper portfolio allocation. So we tell our investors, at the most, you shouldn't have more than 10% of your overall investment portfolio allocated to alternatives, and startup investments are going to fall under that alternative umbrella. And then second, and incredibly important, is having a diversified portfolio. If you invest in one startup or two startups, that's a really fantastic way to lose a lot of money. When you look at the data, if you build out a portfolio of 10, 15, 20 investments, having that diversified pool is when you're going to start seeing the returns that this asset class can generate.
Okay, and Ethan, also, you interact with students and future entrepreneurs. In your experience, what do you think your students in your class are most interested in learning? But also, what are some of the biggest misconceptions that students have about getting into crowdfunding to begin with?
So I think what ends up happening a lot is that people get locked into long-term campaigns. So one of the #1 problems is people think they'll be out of whatever business they're doing in a year, and that's just not how it works, right? So I've classes of, we've got startups out of the class like Warby Parker and things have come out of Management 1, the class we teach. But nothing's out in a year, right? So in the same way with crowdfunding, people think this is going to be over. I can do something really quick, and they're not sort of prepared for the long term. So putting that thought in advance, which is sort of a theme that you're hearing here, making sure you want to be committed to making this thing happen, that you might spend the next 2 years becoming interested in. One from our class is smart mirrors, came out of a class. Another one was ski gear. So you really want to make sure you know that you want to do that thing. It's not a side project. It is a startup venture, and you want to commit to it.
Yeah. And also, Krishan, do you have anything
to
definitely.
Add to that? This is an analogy that I use all the time. 10 to 15 years ago, pre the crowdfunding era, if you wanted to launch a business, you first had to create a business plan, hire a team, build out your prototypes, try to get some funding, get an office space, get a sales team, and then go to market. Fast forward to 2018, with the advent of ubiquitous crowdfunding, you first build a prototype, then go to market. Then, based on the market reception, build the team, build a marketing plan, get the investment. So it has fundamentally shifted the model on how to start a business on its head. With that in play, one of the biggest misconceptions people have is that it's easy. It actually is most businesses, early stage businesses, will never do $500,000 to $1 million a year in revenue. And a lot of the crowdfunding campaigns we work with and our panelists work with are doing that in a month, maybe 5 weeks. So you're condensing a year's worth of time and pressure and resource and hard work into just a couple of weeks. And the whole preparation from pre, during, and post, to Ethan's point, what is happening after the campaign? How are you going to activate this loyal community post-campaign? It's really a full life cycle that you should be mindful of.
Mm-hmm. And Nico, when it comes to regulation, that's a big topic we've heard earlier about here today. So what are some of the key things investors should be focused on when it comes to regulation?
Yeah, so from an investor standpoint, especially if you're a non-accredited investor, there are limits on how much you can invest in this asset class per year, and that's a good thing. That's in place to make sure that, I think one of the big fear that everybody has around equity crowdfunding is, grandma, betting the house on a startup. When it inevitably fails, then she's underwater. So investors need to be cognizant of that. It's generally based on a percentage of your annual income or your total net worth. There are some more interesting things that come into play as well. Especially when it comes to Reg CF. Even if you're an accredited investor. If I'm Warren Buffett, I'm capped at making $100,000 of investments into companies raising under Reg CF in a 12-month period of time. So there are a little bit more nuances there that don't really make sense on their head, and we probably need to do a little bit more work on the regulatory side to get those addressed when you're looking at how much you can invest in these companies per year.
Mm-hmm. And Ethan, do you have anything to add to that as far as regulation? Are you teaching your students how to navigate this area?
Yeah, so I think that you still need expert guides for equity crowdfunding right now. It has not taken off in the sort of independent way that reward-based crowdfunding has, for a variety of reasons, some of which you mentioned. There's a confusing sort of alphabet soup of various letters. It's not quite clear how equity crowdfunding relates to later stage VC funding, how you get your money out of these markets. So it's a complex area. So mostly have my students do reward-based stuff right now when they're looking at this. Right. But again, there are experts who can help you with it, but it's a harder road with a lot more choices to make as opposed to 1 or 2 platforms that everyone goes with.
And you also teach a class on entrepreneurship as well. So speaking of that, even though crowdfunding has changed the traditional model of how companies raise capital, there still are some fundamental things that need to be in place as far as building a business to create value before you ever even think of launching a crowdfunding platform or even going to a venture capitalist to seek any sort of funding. So I want to start with you, Krishan. what do you think startups need to have in place to be successful before they even approach your agency to try to build that platform?
I'm in a fortunate enough position where I'm fielding 20 to 30 of these calls a week where entrepreneurs all over the world are pitching their ideas and saying, hey, let's partner together and raise money in the equity world or the rewards-based world. And just to add some color to what Nicolas was saying, when he says the word Reg CF, he's talking about regulation crowdfunding, which is a form of equity crowdfunding separate from the rewards-based crowdfunding world, where the cap is $1,070,000. That's as much as you can raise. And that is a very regulated sort of way of equity crowdfunding. So when we're using these terms, just know that it's a specific form of equity crowdfunding. And to answer your question, one of the things entrepreneurs need to be mindful of the most is, just take a step back. Let's not get lost in the terms of what we're doing. Does the product or service you are offering, and I say this all the time, dozens of times a week, does the product or service you are offering add value to a given target audience at a decent enough price point that incentivizes adoption? Or why is your product going to work? A lot of entrepreneurs glance over that, where I feel like that is the fundamental pillar of a business. Why does your product or service need adoption? And have you focused on your value proposition, your competitive differentiators, and your pricing strategy to incentivize that adoption? So to that point, it's the strategic backbone of the company that I think most entrepreneurs glance over, and they focus on the fancy videos and the lifestyle photography and the big social media followings, when in reality, that's not really going to make a big impact on conversions on the campaign.
Ethan?
So crowdfunding is one of a menu of options for funding your company, right? So if I look back at teaching entrepreneurship, the big revolution in the last 10 years has come from the fact that the cost of dropping a web-based startup from when I was an entrepreneur in the late 90s, early 2000s to today has been a threefold decrease, 3 orders of magnitude decrease in the cost of launching a web-based startup. What that's meant, and the same thing in hardware, huge price drops. So what that's meant is that you actually can do a lot more with a lot less resources. So what's happened is it used to be VC or angel investing or nothing. Now there's all of these other sources of fundraising that have filled this gap, right? We can talk ICOs, we can talk accelerators or incubators or crowdfunding. So this is part of a menu of options that make it possible for you to launch your business. And you want to make sure your financing options match your strategy. In some cases, that works really well. If you're doing a consumer hardware product or you're making fashion accessories, crowdfunding is great. If you're doing enterprise software, crowdfunding is not right for you. Right. So you have to still go through the same process of launching a business that you would before. But now you've got this sort of option about funding, especially in the very early stage, what we call the seed stage, before Series A, before VC gets involved, raising $1 million, $500,000, where you have a lot more choices than you did. And that's exciting, but it doesn't forgive all of the other things you need to do to launch a business.
And Nico?
And yeah, I think kind of going off of what I said earlier, we see for equity crowdfunding, we see idea stage companies, most pre-seed companies, you're just not going to be at a place where the investment's going to resonate with the crowd. For a lot of our companies, we encourage them to kind of have that initial emotional hook when they're talking to investors. It needs to be something that will resonate with the crowd. Surprisingly, we've seen a lot of very much B2B companies, even enterprise SaaS companies, which you wouldn't think would necessarily resonate with the crowd, be something that's interesting to our crowd investors. But that being said, once you have that initial emotional hook, that very clear value prop, we've seen the crowd be incredibly diligent and frankly tough on the companies on our platform. They're going to dig into a company's financials and ask the hard questions. They're going to take a look at the company's projections and say, if you're an early stage company, seed stage company, and you're planning on paying your CEO $150,000 a year post raise, they're going to call you out on that. They're going to take a look at your projections and challenge your key assumptions there. So your company needs to be at a stage, and you as a team need to be ready to answer these hard questions, because the crowd does just as much diligence, because these are meaningful investments for these individuals.
And I also want to talk to you, Ethan, about diversity. We did have a whole panel on that earlier, but you are doing some work in this. And do you think that investors in the crowd, they're more likely to invest in women? And what I really want to know is, why is that investors in the crowd are more likely to invest in women and diversity as opposed to a traditional venture capitalist?
Yeah, so that's a complex question. I'll do my quickest version of it. But so the thing to start off with is, okay, the way we fund innovation and entrepreneurship is totally broken, right? So I'm from Wharton, University of Pennsylvania. Wharton grads and Penn grads have raised more money last year than the nations of France and Germany combined, right, in terms of venture capital, right? I'm not joking. And we're the third highest VC raise after Harvard and Stanford, right? So that something's wrong there, right? So that clearly we're not funding innovation everywhere. In fact, the mean distance between a venture capitalist and a company to invest in is 80 miles. Right? So if you're not in Silicon Valley, you're not in New York, you're just not getting funding. Right. So there's all sorts of broken stuff. Women make up about somewhere between 3 and 8% of all VC money, despite making up 39% of business owners in the US. So stuff is broken in lots of different ways and in very complicated ways, right? Usually it's not out and out animus or misogyny. It's a lot of complicated things about networks and connections and who gets access to things. Crowdfunding lets you make an end run around some of these systems. And so a woman running the same project as a man on Kickstarter is 13% more likely to succeed than men. And almost all of that comes from the support of other women, and women succeed best in areas where there are the least other women involved. Women help each other out when there's the least other women. So there's a lot of complexity. Geographically, we find that once an area receives crowdfunding that doesn't typically get VC, VC investment starts to follow into that geographic area. So there really is this interesting democratizing force that happens. It's a really complicated set of questions that I don't want to take up too much time worrying about, but in the panel. But part of the reason is who can support you is different. So you're drawing on other networks rather than just the VC network. And the VC network tends to be very homogeneously top school. It tends to be very male, tends to be very white. And once you break away from those networks, you end up with a lot more diversity kind of coming in and new support networks forming. And I think that's the most exciting thing about crowdfunding.
And Krishan, do you want to add to that?
Definitely. And on the marketing side, what was before a disadvantage, whether you are a male or female of color or from a different socioeconomic standpoint or a geographically abundant standpoint where you're not getting the funding you want, now in the crowdfunding world, you are almost using it as an advantage, right? We are two females, minorities in Miami, Florida, raising this round of funding through crowdfunding. Help us, and that message of women empowerment or minority empowerment is received very positively through the crowdfunding world. It's actually an advantage versus a disadvantage. So a lot of great benefits come out of that as well.
And Nico, have you seen this as a leveler?
Yeah, so I know that we do have a concerted effort at SeedInvest to democratize the asset class for investors, but democratize access to capital for entrepreneurs. So there is a really strong push, and I think we see this at a lot of different equity crowdfunding platforms where we are actively going out there and trying to identify founders of color, trying to work with female founders, and trying to really build in the geographic diversity. And from an investor standpoint, specifically speaking to that geographic diversity, we actually see that be particularly interesting because if I have a startup in Silicon Valley, or if I have that exact same startup in Kansas City, that Kansas City startup is going to have a much lower valuation. So when you go to these second and third tier markets where you have really strong companies, they just don't happen to be in Boston, New York, Silicon Valley, there's some really great value to be found there from an investor's perspective.
So that's interesting. If you're looking for funding, if you're a startup, sometimes it's better to start with crowdfunding just to get your business off the ground. Then you can go out and get that venture funding to grow your company. Krishan, I want to talk with you because so much of launching a startup it's about gaining traction. You could have the greatest idea in the world, but one of the things that your agency does very well is you help entrepreneurs find targeted investors and customers. So talk to me a little bit about that. When you're a startup and you want to gain traction and you want to find that targeted customer base, what advice do you give to your startups? And
this is, I've presented at a few universities over the past few years, and I give this advice all the time. Really, the key formula is persistence and creativity. As obvious as that might sound, or as fluffy as that might sound, I'll give you a concrete example. When doing a crowdfunding campaign, one avenue of traction is through press, whether it be low, mid, or high tier press and publications. And most startups think that you need a PR agency on board to make some of that happen. Well, one of the very first crowdfunding campaigns we ever launched was covered on a national level, and we never even had a PR agency or an internal PR team working on it, and we just got creative. So if you go to google.com and go to the news section and type in keywords related to your business or your product, you'll find hundreds of articles written about competitors, your product, your industry. Now, 6 out of 10 times, if you click on that article, underneath the headline of the article will be the author's name of the article. If you click on the author's name, you'll find their Twitter handle and their email. There's no reason why any entrepreneur who wants to do a rewards-based or an equity crowdfunding campaign should not have a 500 to 1,000 line Excel sheet of reporters all around the world that have written about competitors, products, industry trends, and doing individual outreach to all of them. Now, it takes time. And as Ethan was saying, direct correlation between preparation and success. It is grueling and it's a headache to do it, but that's where you plant the seed for success. And even if you look at it from a formulaic analysis, you have a list of 500 reporters, expect a 15% response rate. You'll have roughly under 150 people respond to you, and 10% of that actually writing about you. So you have 15 to 20 articles over a 40 to 50-day campaign, 1 or 2 coming out every other day, and you do that completely without a PR agency. Getting creative and reaching out to angel groups in your community, business school alumni groups. There are many ways to do it. Now then, you can get more advanced on the agency level. What we do is run heavily targeted ads and have our own email lists and have our own networks, but there's a big layer of the foundational work that can be done without any outside support.
And what about strategic partnerships? That's probably another way too. If someone else has a following, you can align yourself with them.
Yep.
Ethan, do you have anything to add to that?
I mean, but don't neglect the basics. So a single spelling error in a Kickstarter campaign description lowers your chance of success by 13%, right? So like the crowd is, like, I think as much as we're talking big picture stuff, crowds start with community, right? We're talking funding a lot, we're not talking crowd enough. So it is a crowd, right? It starts with your friends and family, it starts with your community of online folks. So if you're known as like the best knitter, and actually some people have been studying knitting communities online, and you have a reputation in this online community as being great, when you launch your campaign, you'll get money. The Oculus Rift, right, started by Palmer Luckey, the VR sort of thing, started with a community of virtual reality enthusiasts who refused to deal with the death of the VR world in the late 90s when Lawnmower Man came out. Terrible movie, killed the VR industry. And then they worked on it separately, and Palmer, when he posted about this, said, look, I just want to raise enough money for some beer and to make sure my friends can get a handle of these goggles, and sold the company for $2 billion, right? So the issue is you start with community. That's where all my stats show the stuff comes from. So all the other PR is great, but if you don't have like that online community that trusts you and supports you, that's where the success often comes from.
Mm-hmm. And Nico?
Yeah, I think when we're looking at the raises that we do, we really see, for most companies, there are exceptions, but for most companies, we see there being 3 pillars to a successful fundraise. The first is kind of the offline portion of your raise, the friends and the family that you're closing offline, angel investors you're talking to offline, VC investors you're talking to offline. The second pillar very much is your community. It's really building out that community, building out the top of the funnel, whether that's through your own user base, through emailing them, through running digital ads, through other PR and other media campaigns. And then the third pillar we see are the investors on our platform. And we really see those 3 pillars working in concert, kind of communicating to each of those groups in an effective manner, because the messaging will look very different for those 3. And if you can kind of nail and have all of those 3 things in place, then you're going to have a good, successful fundraising campaign.
And that's really great advice. And we are running out of time, so I have one last question for each of you. Krishan, I'm going to start with you. So what's the craziest business idea you've all been presented with?
This is still a regret that I have many years ago. This was several years ago, and I opened my email. It said, very innovative idea. And I opened it. I'm like, great subject line. I open it. And it was a couple of years ago, before the virality of the product took off. It said, hey, I have an idea for a fidget spinner. You put it in your fingers, and you spin it. And I'm like, what a horrible idea. Like, there's no way this is going to work. Who's going to sit there fidgeting with the little spinner? And, a couple of years later, it's globally viral. So, like, that was one that was a crazy one for us.
And Ethan, I know you have to be careful with this question because your students are watching.
Yeah, so I'll say 2 things really quickly. One is, every time a student's successful and they come back and give a talk in class, I have to open up their final grade. And there's this rumor that turns out to be true that the business school professor who graded the FedEx final project gave it an F. Right, and I'm always worried that I'm gonna, that's gonna be like the C- project that raised $100 million. So that hasn't happened yet. Mostly A- for those folks, which lets me think I've added value. But we do have a list among various business school professors who teach entrepreneurship about ideas we don't want to see again because everyone does them. So I will tell you, better ways of ordering drinks at bars is played out. Please don't come up with that startup idea again. We have seen that a lot. So.
And Nico?
Yeah, we work with a lot of founders that send us a lot of terrible ideas. Because that is confidential, out of respect to those founders, I won't say talk about those. But there is one deal that we invested in that kind of sounded crazy. It's in a crazy industry, but it was an incredibly interesting investment. It was a company that was leveraging spectral imaging cameras that were originally used by the military to detect bombs in Pakistan and Afghanistan, kind of buried in fields, where they were essentially installing these exact same cameras over cannabis grows, and leveraging that technology to very closely, constantly monitor the nutrient content, the water content, if there are pesticides, if there is mold. So I think that was a really interesting investment because, one, it's a fantastic market opportunity, but also, cannabis founders have a really difficult time getting access to capital because a lot of funds mandates won't let them invest in companies like that. So it was a really good opportunity for a company that didn't otherwise have access to traditional capital to leverage equity crowdfunding to get that capital, and now they're off to the races and doing great things.
So it seemed like a crazy idea, but it ended up working.
Yep.
So that's great. Well, thank you so much. That's about all the time that we have. So really appreciate you guys joining us.